Are parks still the savior of Disney's business? We want to bring in Doug Creutz. He's TD Cowen Managing Director of Media and Entertainment. Doug, it's great to see you here. So let's talk about the parks business. What's your assessment just on their ability here to maintain the returns that they've seen in parks while also scaling and investing with the goals that they recently laid out at their Investor Day, $60 billion?
Yeah, the parks is the part of the business that people don't really worry about. It's an incredibly profitable business for them. They've grown it by investing in the parks business for since basically Iger came in the first time back in 04, 05. And they talked about investing twice as much over the next 10 years as they invested over the past 10 years. I think it makes sense. It's a business they should continue to invest in. The question is, can you scale the size of your investment while maintaining the same level of returns? And that can be difficult to do. I mean, they've sort of admitted that on the content side, they went for quantity over quality, and it didn't work out as well as they would have liked. I don't really think that's any different when it comes to investing capital, that the more you need to invest, the harder it is for that marginal dollar to generate returns. Doesn't mean they can't do it, but it will be a challenge. Even if they do it, we did an analysis that suggested that their investment that they're planning could drive high single-digit EBIT growth over the next 10 years in this segment. Now, that's good, don't get me wrong, but I don't know that it's so good that it really changes anybody's view on how good the parks business overall.
Is this purely looking at the acreage that they have and saying that we need to develop more on top of that, or is this an expansion into new regions that you're anticipating?
It's multifaceted. It's building out on the acreage they have, and at their an analyst day in September, they talked a lot about how they have a lot more acreage available than people might realize at most of their parks. It's things like the cruise lines. They're going to be launching several new ships over the next few years. The cruise lines have been a great investment for them. They've got their Disney vacation hotels, and I do think that ultimately you probably will see some new park footprints crop up in strategic locations, probably towards the end of the 10-year period, but that probably is somewhere that they will head eventually.
So let's focus on the streaming side of things, because the streaming business obviously still unprofitable, although losses did narrow just a bit. When you take a look at Disney's goal, obviously they're doing all they can to really grow their returns here for streaming going forward. How sustainable is that? And I guess, what do you see that upside looking like?
Yeah, so it's a multifaceted problem, right? Essentially what Disney's doing, and this is a little blunt, but they're making the service worse by producing less content for it and raising price. And they're not the only ones that are doing that. All of the streaming services are doing that. These services have been underpriced and overserved with content early, and that's being corrected. But as a consumer, it doesn't necessarily make you feel great. So they're going to get to profitability, right? There's no reason, honestly, that Disney Plus shouldn't be a profitable service, given the quality and the depth of the content that Disney has, the strong brand that Disney has. The question is, how profitable can it be? And at the same time, what's going to happen to their linear business, right? The linear business, which is under an enormous amount of pressure. Linear TV advertising remains incredibly weak. We're seeing cord cutting continuing at sort of high single-digit percentage annual rates. If they get the linear business, if they get the DTC business to profitability, but the linear business is melting, the total profitability of the entertainment segment doesn't necessarily go anywhere. So they've talked about they're open to strategic options for their linear businesses. I think they're looking very closely at what they can do certainly with ABC and the Fox networks and potentially with ESPN. But that doesn't mean anything's going to happen that's going to them.
Just, Doug, lastly, while we have you, I mean, when we talk about what that advertising business is going to mean in terms of the broader linear, I mean, we're going into an election season next year. Companies in the previous one, we knew that they were more kind of reticent or perhaps sitting back from investing as much in advertising as they would have because they were fearing the content that they would run up again. For Disney, it might be slightly different in some of that consideration, but at the same time, if we do see a pullback in advertising next year, what does that spell out for that linear business?
Well, political is always additive to the advertising pie. We're talking billions of dollars of advertising flowing from campaigns. That does push out some of the sort of standard advertising. It's not fully additive, but the ad market should be better next year because of political. It's a cyclical thing, right? It's good one year and then it's less good the next, and that's been the case for a long time. It will continue to be the case. I don't think it really impacts Disney's structural challenges at all.
All right. Well noted. Doug Creutz, who is the TD Cowen Managing Director of Media and Entertainment. Doug, appreciate the time and insights. Thanks for kicking off the show with us.
Thank you.